Hello, my name is Adonai Jones. I am a music artist as well as a business owner. And today I am here with the CEO of allgoodaccounting.com, Sandra Goodall. Sandra, could you tell us a little bit about yourself and where you come from?
Absolutely. Thank you, Adonai. Well, as the CEO of allgoodaccounting.com, I have been operating this business now for the past 20 years.
Okay.
And I'm very passionate about it.
Okay.
My passion is to help companies grow and understand their finances. And in so doing, they get the knowledge and understanding and how to
Right.
navigate and operate their business effectively.
Great. Pleasure to have you on a podcast. And I'm excited to see what we can get into today. So the first topic that I believe we have is business expenses. So could you, for the average listener, could you go over what exactly business expenses are and how they relate to the business industry?
Yeah, absolutely. Like every business overall incur expenses. It's just a fact, right? I don't know if anyone has heard the term, if you want to earn anything, you got to spend to earn.
Right.
So these are exactly what the expenses are. And in business, there are many categories of expenses. And so I hope to highlight everyone about them. So for them to get as much information as possible and
Right.
to apply and use them in their business. Because there's many, and a lot of business owners tend to not know about them and not claim and get all the benefit that they're entitled to.
Okay. So what is the first topic that you would like to go over?
The one of the topics, the first one I think is important, and it's called cost of goods sold.
Okay.
So cost of goods sold is a kind of expense, but it's mainly geared for inventory-based businesses.
Okay.
So if you're selling a product or, maybe parts, it would apply to you.
Okay.
If you are a business that runs a service, then this section would not apply.
Okay. So what could you give us an example of what that kind of entails or includes?
Sure. So cost of goods sold includes you having what we call beginning inventory.
Okay.
So if you're going to sell cups, so let's use cups as an example.
Okay.
So you sell cups, so you'd either make these cups or purchase these cups.
Okay.
And so your beginning inventory will include the number of those cups along with the cost of those cups.
Okay.
And that would be, one of the line items under cost of goods sold. Okay.
Gotcha.
Yeah.
Okay.
And then after that, we would have, so that's what you start off with initially throughout the year. And then throughout the year, you would buy more cups or buy parts to a cups. So then we will have what we call purchases. And these are adding on to your beginning inventory that you would have. Beginning inventory is something that rolls over from year to year.
Okay.
Like if you're just starting out, you wouldn't have a beginning inventory. You probably only have purchases.
Right.
So the purchases are the actual inventory items that you purchase throughout the year.
Gotcha.
Then, of course, you have returns. Like not all items you buy are going to be what you want.
Okay.
Right? Some of them may have defects. Like maybe when you buy a cup, it's not the right color or the right shape. So then you would return them. So the next item would be the return. So the cost that you purchase it would be purchases, and then you have the returns of returning them because maybe they have defects
So
and stuff
then
like that.
the business owner would have to pay to return the defective items. Is that how that works, or they get recompensated for that?
Yeah, so the returns basically would entail, say, as a business owner like yourself, you would have purchased these items.
Right.
And then based on what you see, they're not aligned with what you've ordered, perhaps.
Right.
Then based on your agreement with the seller, you would then return them. But but now that they're leaving your inventory, you need to record it as returns, because now because cost of goods sold is a way of tracking your inventory. So you need to record those as it's like it is an expense reducing your inventory.
Gotcha. Okay. Yeah.
And then once you have your beginning inventory, sorry, my voice is going a little bit hoarse.
That's okay.
Once you have your beginning inventory, which we spoke about earlier, you then have your purchases, less our returns.
Yeah.
We have what you call your cost available, your cost of goods sold available for sale. So these are your cost of goods available for sale. And this is a line item that, on your financial statements, one will be able to see that is what you had available for sale throughout the year, for the year. And then after that, as the year went on, you would then, at the end of the year, you would then do either a physical tally of all the inventory that you have left after all the items have been sold. So, or if you have a digital system, you would then be able to look it up. And so inventory can be calculated on a perpetual basis or on a physical count. So on the physical, you actually go in the store and just count,
Just
1,
count it
2,
out
3,
one
and
by
then,
one, okay.
count it out. Yep.
Okay.
And so then you record that as your ending inventory.
Oh, okay.
Or under the perpetual system, like, say, how you have Shoppers Drug Mart or any one of those grocery stores.
Right.
They use the barcode, and the barcode that they click, is actually, when you purchase those items, they're reducing the inventory in their system.
Right.
So on a perpetual system, it's whatever is left at the end of the year.
Right.
You could actually see it. There's no physical count that one has to do.
Right. It's already in a system.
It's already in the system.
And it's already in an inventory computer.
Yeah.
And it already leaves the system when someone purchases it, and it doesn't have to be physically accounted for. Right.
Yeah.
Okay.
Yeah, exactly. So,
cool.
And a lot of companies do that more so.
Yeah, I think that's better, where you don't have to physically go and count one by one, because obviously that's not effective in today's world.
Well, to be honest with you, and that's a great topic that you brought up, because the perpetual system, although it's most effective and most, as you can see, we're in a digital economy now, that most systems do apply to that. There are systematic errors, so management usually account for that.
Right.
And it does not account for things being stolen. So there is an actual physical count that do happen in spite of the perpetual system.
Right.
That is applicable here.
Gotcha.
And so in a case like that, at the end of the year, they do hire extra staff at year end, and it take anywhere from depending on how big the company is, it could take anywhere from a few days to even a month.
Right.
To physically count inventory.
Okay. Good.
Yeah, and then so once you have your ending inventory, that would be then be what's left over after all your sales throughout the year.
Okay.
And then once you subtract that from the cost of goods available for sale, then you'll have what you call cost of goods sold. And that is the number that is key, one of the key expenses on your income statement, because with that number, one is able to calculate a company's gross profit, which is what gross profit is the dollar value that one would earn per sale. So So for example, if I have a so it's subtracted from your sales. So gross profit is a direct number that reduces your sales. And so that number that you have would be what you call either gross profit margin or gross profit. And you get a percentage from that. And so you could then tell how healthy the company is, or how it's, or how healthy it is. So if I have a gross profit margin that's 50%, that means for every sale I make, I'm able to keep 50 cents of the money.
Yeah.
Which is good. So the higher your gross profit margin is, the better it is.
Okay.
And most companies, they track that throughout the years. So if they see it as something that is going down, then maybe their cost of goods are too high, or maybe their sales are too low. So they have to adjust either one of those two to keep it within the same
Gotcha.
year over year.
Okay.
And there is an industry specific as well. So within maybe the cups industry, let's say, maybe the gross margins are very low. And so that is something within, the organization that they would have to determine.
Okay. Thank you for elaborating on the cost of goods sold. That was very informative. I wanted to get into also the operating expenses.
Okay, good. All right. Operating expenses. Now, one of the things I wanted to add into operating expenses is operating expenses are the overall expenses.
Okay.
For the business. And what I mean by that is these expenses will happen no matter what. So rent will always be happening. It's not determinant on sales. The supplies that you have, they will be happening. It's not directly related to sales. So the operating expenses are the expenses that are left over.
Right.
So how that ties in with gross profit, which we just spoke about, is that this is, I gave you the example of you earn for every dollar sale you make, you're able to keep 50% of it.
Right.
That is good because the rest of it would have to be covered.
Okay.
The rest of that dollar amount where you keep for sale, then, it has to be applied to the operating expenses. So if you have a low gross profit, then you wouldn't be able to cover your expenses. So that is how it ties in here. So operating expenses, definitely we could talk about that and give you more information.
Okay, great.